Welcome to Horizon Advisors Q2 Review. I'm Jay Shook. This is Brad Spindler. So this week, or this quarter, I should say, we led off our letter with a quote from Benjamin Graham. Investing isn't about beating others at their game. It's about controlling yourself at your own game. I think it's incredibly applicable when we look back at what we saw through this quarter, especially for those paying attention in April. Lots of volatility. If you were looking, a lot of volatility down to start and a quick recovery. If you were not making any moves, you did just fine. If you were a buyer at the right time, you did fine. But if you panicked and you sold, well, you're probably kicking yourself today. So as we look back, I think this is one of these things where you have to be in a situation that you're emotionally ready to go through a downturn and not have to feel like you're going to get out of the market just because stocks are cheap. Generally, that's the opposite. Wouldn't you think so?
Absolutely.
So, for our clients that we talked to, if anybody was nervous, we were walking them off that ledge. It was a situation that we were advising, of course, anybody to stay the course. That was the right move in hindsight, at least today. But recoveries aren't always that quick. I think we have to be emotionally ready to sit back and be down in our investments that are designed to be long-term, longer than maybe just a month. And it doesn't always recover so quickly. It almost never does, actually. But it's important to note that if you do go through those things and you ride it out and you got a plan, you're going to be okay. As we get into that, it's one of those moments we have to look back and we say, where are we in not a month or 2 months? Where are we at in 2 years or 10 years or 20 years? Because that's really the design behind any investment that is in the stock market. If we kind of take a look now, where are we sitting today in performance?
That was a great intro, Jay, and the performance has been a roller coaster, to say the least, in the U.S. stock market. So we started this year, the first 2 months were positive, and then we had a 20% drawdown intraday, which is technically a bear market, and then we had a V-shaped recovery, and the S&P 500 is up about 4% on the year. It was the second fastest recovery in stock market history. So if you blinked, you did miss it. Like Jay mentioned, those do not always happen that quick.
And I know, if we take a look even just beyond the S&P, right? That's we're in the United States here, right? That's the big index we're going to pay attention to. It's pretty broad. There's also global indexes, and how have they performed?
Absolutely. So the global indexes are up around 16% year to date. They're in a full bull market right now. And also there are bonds. U.S. bonds are up about 3.5% year to date. So if you were globally diversified, you didn't feel as much of the pain in April as if you just owned United States stocks.
Yeah, I did. I saw a quote recently that said you're not truly diversified until you own an asset class that you don't want to own. And I think this is a good example where if you've been in international stocks for a long time, obviously you can have a different percentage of your portfolio allocated that way, but you probably weren't real happy with it up until this year. And it's lagged the S&P. It is what it is. But, these are one of those moments in time where you had a lot of volatility in the U.S. We've had, even though we've had the recovery, we had a much larger run-up so far in international positions. Where we go from here remains to be seen. But it did finally pay off, at least for the time being, to be diversified.
It did. Jay, why don't you give us an update on how the valuations look in the market now that they've recovered back to almost all-time highs?
Yeah, that's a good way to put it. When we finished our quarter one review, we put out there that we thought stocks were expensive. Doesn't necessarily mean that's a bad thing. When stocks are expensive, there's a reason for it. There's optimism. There's expectations of growth in the economy. At least that's the assumption. We saw that pullback as we got into these trade negotiations and a lot of fear hit the market. We've recovered. We're actually sitting today, as we record this, at higher valuations, at least the way we measure them, than we did at the end of Q1, which is kind of surprising, especially considering the drawdown that we saw right as Q1 ended and we got into April. So today, we're big CAPE ratio guys. We're sitting at around 36. If we look at the forward PE ratios, those are up as well slightly from the last time we ran this meeting. We're about 21 right now, but regardless, things are pricey. Doesn't mean you need to get all out of the market. It sort of goes back to what we saw in April. Don't panic. Opportunities might present themselves. If you got some dry powder or investments on the sidelines, you'd be willing to liquidate and move into stocks. That opportunity might come up. Remains to be seen.
I'm going to play devil's advocate a little bit here. I agree the market is a little pricey. So the forward PE, like Jay said, is 21 on the S&P 500. Long-term average is around 18. So I would agree that is pricey. However, the equal weight price to earnings ratio of the S&P 500 is 16.8, which is about the 10-year long-term average. So it appears fairly valued on that. And then if you want to talk technicals, not that we're big technical guys, but XLK, which is the technology sector of the S&P 500, which also makes up a third of the S&P 500, they're in a bull market technically right now. 70% of those stocks are above their 50-day moving average, and about 53% are above their 200-day moving average. Now, that's for shorter-term investing, usually, but that is a very bullish signal short-term.
Yeah, it's, there's obviously a lot of momentum, and that's not a secret. We see that in the markets both up and down, and it's a lot of the emotions that come into play that drive some of that, at least. It's just a tough call. I think you need to have that long-term plan.
Absolutely.
You stay the course, meaning if you got a portion of your portfolio that you're going to invest in stocks, because things pull back, like we saw in April, if you're selling at that point, it's probably not a good investment for you. If you're the guy who looks at it and says, I'm just going to ride this out, or maybe I'm going to throw some more money at the market because I feel like I have some discounts here, right? It's on sale. Then you can handle that type of volatility, and it's okay. Otherwise, you probably want to err on the side of caution, especially when things are this expensive.
I would agree.
So momentum works both ways, unfortunately.
Yes, it does. It can be a blessing and a curse.
The other element here is, and we'll mention it, of course, in our letter, which is staying disciplined. And if you have a plan, you have to stick to it. So I know a lot of people think they do have a plan, or at least they tell themselves they do. When the emotions hit, it's hard to follow it. That's where maybe your advisor can come into play. Give them a call, harass them, but let them know you're a little bit nervous, and help them or have them reassure you. I think that's a good way to work with your advisor.
Absolutely. So back to what Jay said about staying disciplined and handling volatility. We did talk about that in Q1, and we want to talk about that again here, because you should have stayed disciplined in Q2. So when things were falling, it's easy to see a bunch of reasons online or in the news to sell. There's always reasons to sell. However, that would have been about the worst thing you could have done at the time. We stressed importance to retirees. Stay invested, stay the course, stick to your long-term plan. There are always going to be market fluctuations. And we also talked to some of our younger clients during this time who had extra capital to put to work. When there are periods of volatility, usually the best opportunities in the market tend to present themselves at that time.
Yeah, absolutely. I think for people who are still working, saving in employer plans, 401ks or otherwise, the volatility doesn't really hurt you. As long as you're willing to stay the course and every paycheck you've got money flowing in, when the market's down 20%, you just got the same positions you were buying, a month ago at 20% discounts. So it doesn't hurt you. You need to be able to go through those ups and downs. Most of our clients seem to do a pretty good job of that. So I felt, even though we had some excitement, we came out of it pretty well on our end.
We did.
As we look ahead, the other thing, of course, is just what's going to happen. It's an unknown. It's always an unknown. I don't think that's ever going to change unless you get that crystal ball, but maybe we'll get one.
I'm looking for it.
In the meantime, the biggest thing that we've really seen driving these markets lately have been margin increases, and a lot of that's coming from artificial intelligence. That's the buzzword these days, but it is a thing. It's real. We're seeing it affect profits, and that's happening mostly, unfortunately, through layoffs and streamlining companies. So what happens on the other end of that, unquestionably, it remains to be seen. It can drive unemployment. It can obviously affect people that are collecting a paycheck if they were to get laid off. That the U.S. is a consumer economy.
It is.
So we're going to see what happens as that really starts to work its way through our broader economy. It's starting kind of in the tech sector initially, but we're going to see it expand out. And I can't speak for everybody, but we meet with plenty of clients on a weekly basis, and there's probably more concern around job security, that I've heard in the last several months than I've heard other than 2020 when COVID first was hitting, and it's a unique time as things change.
It is very unique, and it can be scary if you're in that position where you might lose your job to artificial intelligence. But as far as companies go, it's doing well for them. Like Jay said, gross profit margins and net profit margins have all been increasing in the last 6 months, with a lot of that due to AI and layoffs. On the back end, hopefully new jobs will be created because of AI, but that is yet to be seen.
Yeah, I think it's, beyond just investing, it's key if you are concerned with your job or employment, that you're building that safety net, something we encourage all our clients to do. Buy yourself some time if you were to have to be job searching. That's part of investing in that diversification, right? Cash on hand makes a big difference if you got 3-6 months or longer, even potentially, where you're looking for work. If everything's tied up in the employer plan in the 401k, it can be difficult to access those funds, at least without penalties. So that's one of those unique scenarios. If that's a concern, maybe you're thinking about where your money needs to be a little bit differently than you were if you feel very secure at your job.
Absolutely. That's a great point. I'm a big proponent of always having a liquid emergency fund, at least 3 to 6 months. Everyone's different. Everyone's situation is different, but that's a very powerful tool. Where do you think rates go from here, Jay?
Yeah, I don't expect much change, at least not unless we see some significant news in the economy. I think what you'd have to see is either high inflation to really drive rates up potentially, unlikely right now. The other side, people have been assuming rate cuts for a while. We've seen the Fed be very slow in the way they're moving, deliberate, whatever word you want to use. But as they look ahead, I don't think they want to make any major moves until there's more clarity, specifically in the trade agreements, or more certainty there. On top of it, I don't think they're very motivated to push rates down quickly either way. So we could see a rate cut or several rate cuts this year potentially. If that does happen, I still don't think it's really going to drive markets. I think that's more or less priced in unless we saw a major move. And again, that's probably only occurring with high inflation or with very bad economic data.
I would agree.
So in the meantime, as always, stay the course, have a plan, stay disciplined, and we'll see you at the end of next quarter.